since 08-09. The trend has been down towards a flatter and flatter yield curve. We didn't get back into the 200 to 300 basis point range as the Fed was flooding the economy with money. We didn't. What was this pointing to? And we think there's an underlying deflationary narrative building into the yield curve. We'll see if we get above the 150 with this easing cycle, and we should know by the end of the year. If we don't, what that would tell us is that this deflationary...
Greetings and welcome to Tesla Hype, everyone. Things like these don't occur very often. Every few decades, economic forces and new ideas clash over the definition of growth. Cathie Wood of Ark Invest claims that we are currently living in a time similar to 1995, when the internet revolutionized the global economy. Then, as markets grew on optimism and new technologies, the laws of business shifted. A larger wave driven by blockchain, artificial intelligence, robotics, and nuclear energy is on the horizon, according to Cathie. She believes that productivity will increase, inflation will decrease, and real GDP growth will exceed expectations. Although most people fear stagnation, she believes that innovation and deregulation might transform deficits into surpluses, as robust growth did in the 1980s and 1990s. After being slowed down by regulations for a long time, nuclear energy is now gaining popularity once more. This is because processing power and electricity are becoming more and more necessary due to artificial intelligence. A new era of production may be ushered in by small modular reactors, improved storage, and more open tech and cryptocurrency marketplaces. In her most recent episode, Cathie defies conventional wisdom by devising a plan that emphasizes opportunities, progress, and fresh perspectives.
Years, higher interest rates, higher food prices, housing affordability, so very difficult times. Now, what I find interesting about this chart is, sure, again, we're in this rolling recession. We think it's the final leg of the rolling recession. And what I'm eager to understand, as the Fed cuts rates, this will continue to steepen. But if you look at the trend since 08-09, the trend has been down towards a flatter and flatter yield curve. We didn't get back into the 200 to 300 basis point range as the Fed was flooding the economy with money. We didn't. What was this pointing to? And we think there's an underlying deflationary narrative building into the yield curve. We'll see if we get above the 150 with this easing cycle, and we should know by the end of the year. If we don't, what that would tell us is that this deflationary narrative, I keep using the word narrative, that we have, it will raise the probability that that is correct. And that is the long bond picking up on that and not increasing as much out of fear of inflation as the Fed eases. So stay tuned on this one. It should be very interesting. Inflation, okay, lots of fear about it. This is trueflation, the trueflation CPI, and as of this morning, again, this is a real-time measure, and it's tens of thousands of goods and services in real time, constantly. Today, we're at 1.9%, and that's with tariffs getting into the inflation rate. They're certainly reflected in here, and I think everybody's expecting a big burst of inflation because of tariffs, and so far it hasn't happened. And what I just discussed in terms of fear and velocity slowing down and all of that could be a reason. Here are consumer inflation expectations. So University of Michigan inflation expectations went wild. Not so true on the Fed's measure of inflation expectations. So UMich is a 5-year expectation, and it's up there at 3.5% over a 5-year period. The Fed's is a 3-year, it's at 3%. We think both are going to come down dramatically during the next few years for reasons I have already described. And I do think UMich, and I relied on that survey for gosh, they started it, I think, in the early 70s. I wasn't in the business then, but for my entire career, I've relied on it. It has been much more reliable at turning points in the cycle than other metrics. I think it has failed us this time, and it seems like a change in their survey methodology has really hurt that particular metric. Here is economic uncertainty, and I think this is a Fed measure, if I'm not mistaken, but it's the uncertainty index for the United States. You can see that it has spiked with higher rates and tariffs and all the drama around politics and so forth. It's improving, but is not down to where it has been historically. And again, all of the uncertainties. Businesses are uncertain. Am I going to lose my business to AI and automation? So it's not just employees, it's businesses who are uncertain. Again, another reason for the velocity of money to drop. Here I'll just feature what has happened in the last few quarters when it comes to GDP. And you can see the headline GDP in the second quarter, 3.3%, pretty good. But you have to compare that to the second quarter, minus 0.5. So really, on average, it's been 1.5% at an annualized rate, maybe. And you can see the distortion caused by trade. Huge increase in imports in the first quarter, which is a drag on GDP. And a turnaround in the other direction in the second quarter, not as much of a drag. So it didn't drag GDP down as much. And you can see inventories are kind of the flip of that. A lot of imports went into inventories and have been taken out of inventory. So huge distortions associated with trade. You can see right below there, core GDP, which is PCE plus fixed investment. And this is what the Fed really pays attention to from a real growth point of view. Very slow. Now, that said, for the third quarter, the Atlanta Fed's GDP now is up to 3.5%. And we'll see how that's revised in the next few weeks with more numbers. But historically, the headline GDP, which seemed fine, was driven.
Cathie starts by talking about the deficit, which is something that investors are always worried about. She said that tariffs and increases in taxes are already helping to ease tensions, even if the news says the debt is too high to handle. The deficit is almost 4.7% of GDP. But history shows that growth, not cutting costs, is the real solution. Deficits can naturally go down when real GDP grows quickly, just like they did in the 1980s and 1990s. She says that growth is now possible. Markets don't realize how much more productive AI, robotics, energy, and blockchain are making things. When combined with deregulation, these pressures may be the most powerful tools for restoring fiscal balance. People think that the U.S. is quickly entering a new economic cycle instead of slowly moving towards stagnation. But growth also causes problems in the job market. Cathie's next area of interest is how job creation, unemployment, and the growth of AI are already transforming the way labor is done.
By government and government-related sectors disproportionately in this last cycle. So government spending itself, that is unwinding. Healthcare and education, much of that is government funded. And so we're starting to lose those, and it will have to be the private sector that comes through. And that will be a very healthy mix for markets, and we think that's going to happen. Here's the real GDP but versus productivity, so real GDP in purple, productivity in green. Productivity was revised up in this latest quarter. I think on a year-over-year basis, yes, we're in the 2% range. And now we think, and this just goes back to what do we think is going to happen during the next few years, we actually think this is going to go up for cyclical reasons. You see, after the shaded areas, which are recessions, you get a bounce in productivity. And we think after this rolling recession, we will get that bounce. But we think it's going to continue and will be more sustained than it has been historically in the 5% plus range. And real GDP is constructed by productivity, output per man hour, times the labor force growth. And that's certainly potential GDP. So that could be in the 5 to 7% range. Many people think this is an outrageous forecast, but we really do believe that this technology revolution is going to cause a step function increase in productivity. So on to the next chart. So back to current conditions. You can see here 50 is the demarcation point between expansion and contraction. Manufacturing has been contracting for the last 3 years. Services aren't in great shape according to this measure either. They're tending towards 50, which is half of the industries rising, half declining. And relative to history, quite low and more typical of recessionary times. On this next chart, you can see real PCE ex healthcare, and it is starting to dip. Again, the consumer's getting concerned. And here is part of the reason. Here's auto sales. Auto sales are coming back down. I think in the latest, it says here 16. Yeah, it should be 16.1. That was the last. I think that's right. 16.1 was the last reading. So it's coming back down after the pre-tariff buying binge. Here you can see personal savings, low by historical standards, up since 22 when the Fed started jacking rates up. We think it could go up further if more and more people are fearful about employment. And let me just talk about what happened in the employment report. So unemployment rate stayed at 4.3%. But employment itself as measured by non-farm payroll, again, something for everyone in this report all the time. Non-farm payroll, only an increase of 22,000. Now remember, the assumption in that 22,000 is that roughly 100,000 jobs were created by the net birth of new startups. And I don't know if that's happening. We'll see in the revision in the next, I think it's the next few weeks, we'll see that revision. That could take a lot of these numbers into negative territory. And in fact, one of the revisions took June into negative territory. And again, we have to adjust for what's going on with immigration right now.
Although job creation is slowing, the unemployment rate remains steady at 4.3%. Work weeks are getting shorter and the revisions are going south for a few months. The latest jobs report claims that while technology and finance are changing, manufacturing is still struggling. The majority should be aware of these warning signs. Rather, Cathie sees them as indicators of structural change, such as blockchain eliminating inefficiencies, AI automating activities, and even government layoffs, which indicate lower spending and temporary suffering, but are actually seeds of long-term productivity growth. Her market view is characterized by a similar theme. Credit spreads show no short-term stress. Inflation has decreased and rates are leveling off. Despite the fact that there are still pockets of excess in bonds and commercial real estate, she argues that creativity remains the true motivation in light of this. By drawing a contrast between the internet bubble of the 1990s and the current adoption of AI and blockchain, she highlights both the risks of overconfidence and the much greater opportunities presently. Her opinion is extremely upbeat for investors in cryptocurrencies. Bitcoin may soon establish itself as a pillar of global markets due to its potential importance in a new economic period. Quick institutional adoption and longevity when compared to gold. Just as the internet era gave rise to trillion-dollar giants, the next wave of AI and blockchain technology may alter wealth generation on an even larger scale. If Cathie is right, this is not the end of a cycle, but rather the beginning of a new one. The next 5 years might be much more revolutionary than most people think.